Terrorism has been causing serious repercussions when financial institutions become direct and indirect victims of the unforeseen disaster. It has also been found that terrorism affects the economy negatively as it creates uncertainty, which leads to investors having lower confidence and perceiving higher risks, as well as lesser trades and investments. It is found that gold and commodity investment does not always hedge off risk perfectly, because terrorism usually affects gold market negatively and the effect is generally more prolonged as compared to the commodity market. Besides that, the United States government bond market is the least affected by terrorism as compared to all other bond markets. Based on the interest rate risk structure, since government bonds are default-free bonds, government bonds are more attractive and have higher demand as compared to corporate bonds, therefore causing the demand curve of government bonds to shift to the right while demand curve for corporate bonds to shift to the left, and the price for government bonds to increase and price for corporate bonds to fall. The corporate bonds that are subjected to higher risk will offer higher interest rates than government bonds, as well as higher risk premium as a compensation for investors who bear more risk. It is also found that on the day of terrorism, the daily returns are most significantly affected, and the magnitude of impact slows down over time, indicating that the impact of terrorism is temporary. In addition, the stock markets in developing countries, such as Indonesia and Thailand, are more volatile and sensitive to terrorism as compared to those in developed countries, such as Spain and the United Kingdom. Terrorism also leads to huge impact on economy as terrorism lowers both human and physical capital. FDI in Spain and Greece have declined by 13.5% and 11.9% respectively when terrorism occurred during 1970s to 1991, because foreign investors transfer their investments to countries that have lower risk of terrorism. On the other hand, countries often restructure their expenditure after terrorism by shifting capitals from production sectors to improve security, which then reduces the efficiency of the productive sectors and result in lower economic growth. Despite the 9/11 terrorist attack being targeted in the US, its financial markets are less affected as compared to the other financial markets in the world. The 4 days closure of the US markets after the 9/11 was intended to allow investors to evaluate the announcement calmly. However, as soon as the US markets reopened, the US S&P 500 plunged for 5 trading days, indicating that the temporary closure of markets only delays the consequences. On the other hand, the European markets that remain open are exposed to high terrorism risk in the US, whereby the anxiety of economic recession caused Dow Jones Index to fall and lost approximately $1.3 billion of market capitalization. In the case of Manchester terrorism, the FTSE 100 index was trading at 0.1% higher at the beginning of the first trading day after the Manchester attack. The market was however closed lower because sterling pound strengthened right before the stock markets closed, whereby investors liquidate their positions immediately and short sell the pound. Despite so, FTSE 100 recovered almost immediately after 2 days, which shows that the UK markets are more resilient towards the news as compared to during the 9/11 attack. Since Malaysia is one of the main providers and consumers of US imports and exports, it allows both the countries to have a good trading relationship, which also explains the interconnection between both countries' financial markets. Similarly, the free trade agreement between Malaysia and the UK also allowed both countries to have a good trading relationship and interconnected financial markets in terms of long-term volatility. The 9/11 attack have caused negative returns and higher systematic risk in Malaysia's stock market, with a decline of approximately 3.9% in the Malaysian equity markets. During the Manchester attack in the UK, KLCI declined by 0.4%, but there is still presence of profit-taking activities in the market. Therefore, the Malaysian market is expected to rebound and rise quickly due to the favorable crude oil prices. It is clear that there is a direct economic damage during 9/11 terrorist attack, whereby it is targeted on the financial markets, whereas the Manchester terrorist attack was just a random attack. Furthermore, the higher uncertainty in the markets during 9/11 terrorist attack has also contributed to greater intensity of influence on financial markets. The 9/11 attack have caused the financial markets to suffer for months, yet the FTSE 100 only took 2 days to recover from the Manchester attack, denoting that there is a diminishing effect of terrorism. Through this study, it is important to note that the stock markets should not be closed after the unforeseen disaster, as it will not address but will only delay the effect of the news on the markets.